Welcome to TradeHappy, a community of traders learning how to be profitable and happy. Today we're going to be talking about where to place your stop loss and where to place your take profit. So we're just on Euro USD at the moment on the 30-minute time frame. These are the live markets. Obviously it is a Sunday, so the markets are closed, but we're currently 15th the 3rd 2020, and let's see if we can try and find a trading setup to show. So I think there might be one here. Let's just get the Fibonacci tool. So when I am trading, I like to use the Fibonacci tool to do my trades, and obviously there's a few reasons why I've shown in other videos why I use the Fibonacci, and I've shown why I chose these settings and everything like that. So if you want to watch that Fibonacci video, I'll put a little card up in the top right corner. Just click the little I button and then you can watch that video and learn more about my Fibonacci settings. But let's say you are trading the same way that I am with the Fibonacci tool. There's two ways that I'll really be looking at doing the trade in terms of a stop loss. So the easiest and most simplest one that I have is just sticking it at the 120 mark. I've kind of just chose this level because it's something that I've seen work in the past, and it's, if you've got a tight range, it normally comes just below the low. When you've got a bigger range like this, it sticks it nice, it gives you a nice little distance of 16 pips on here for the stop loss to not, hopefully be hit. If we're going to reach above these highs, you don't want to be going too far above the highs that it's going to keep going. So, but you don't want to get tagged out if it's just a little wick going above these highs. So let's just say that you got into the trade here at the 72% level, and you stuck your stop loss up there, which is 45 pips. So I'll go over the take profit in a second, but a 45 pip stop loss on Euro USD is not too bad. Obviously, looking back at it in hindsight, it is quite a large stop loss considering where the actual move happened. But it's always good to have a decent stop loss where it's above a high, or you've got some little wiggle room with the trade. So that's the first way that I'll do a stop loss, which is the most, I'd guess say, it's the simple one, where it's just kind of set out for you. You don't really have to do much, you just stick it at the 120 mark, and you don't really have to think. The next one is here. So you'd place it at these highs. So you can either place it at the body of the highest candle of this high, or you can place it at the actual wicks. That's your choice. I will normally do the body. There's no real reason for that. I just like to have a tighter stop loss, and especially if you've got something like this, I'd rather have it here than up here. I know that's a bad example because that's where we're saying we're trading. So up here, I'd rather have it here than up here, because the difference between this and this is 15 pips. So I'd rather have a closer stop loss than, the actual high of the wick. But anyway, getting back to this. So I'd place my stop loss here, and when the trade goes in our direction, when we get down to this 0% level on the Fibonacci, I will move my stop loss from here or here to the entry point of 72%, and I will take a third off here. So that's a part of the take profit stage of this. There's a few ways that you can do the take profit as well. Let's just come down here. So the first way is to take 100% of your profits off at the symmetrical move. So from here to here is the same as going from here to here. I really like to have the symmetrical move just because it seems to work quite well a lot of the time, and it's just it's a nice level to just get out of the markets. As long as you didn't exit when you saw this massive green wick here, you would have hit that take profit. So one of the ways is stop loss up here at the 120 and 100% of your take profit getting out of the market at this level here, which is a 100% move. So that's the first one, which is kind of a basic entry level take profit and stop loss version. The more advanced take profit one is when the market moves down, as I said before. Once we get to this level here, I will be taking a third of my position off and moving my stop loss down to entry. And then when we move down here, when we get to the 100%, I will be moving my stop loss from entry to here, where we took a third of our position off, and I'll be taking another third of the position off here at the 100%. And then what I'll do is I'll leave my stop loss here, and I'll basically just trail it. So if we were in this trade and we came down, I would put my stop loss here at the high of these body here, and then we've obviously come back up and we've gone down again. So on this move down, when we're coming down to about here, I'd say I'd move my stop loss from here to here. So that is 20 pips. So we've gone from up here down to entry, which is 45 pips. Then from entry to our first target, which is 67 pips. And then from our first entry to the first high, which is 15 pips. And then from the first high to the second high, 22 pips. So we're basically moving our stop loss down, not a set amount. Because I see when traders are doing trailing stops, they'll normally have a set amount of pips that they're moving the market, or they're moving the stop loss down following the market. And it's not really something that I've ever found success with. But this is a good way to move your stop loss down and get some of those gains when you've already scaled 2/3 of your position off of your original trade, and you've still got that little slice of a third in whilst moving your stop loss down. So it's just a really, really good way of capitalizing on your good trades. And yeah, I guess this was one example on Euro USD. There's plenty of examples out there where you could find where you just, sit at the 120 mark above the high. And in that case, I'd probably just stick it at the 120. It depends on how much of a gap there is between the high of the actual first point that you place and that 120 mark. Because let's say we move it here. So, instead of, I think it was 16 pips or something, we've now got 12. And you'd still be entering the market here. So even if you didn't put it at this low, you'd put it at this low and you'd still be in the trade, and that would be a winning trade. But then also, if you were in this trade, you could scale, which is another way to add to your positions. You could scale in. So this was the original move. You could also scale in here. And you would be selling at this point here. And your stop loss would not be hit. So even if you put it at the actual bodies of those candles, your stop loss, I suppose it might have been hit depending on what broker you use and the kind of spreads that they have, but if we're going by, exact figures here, your stop loss would not have been hit. But I mean, even if you did put it at the 120, you're definitely not getting hit at the 120 mark. So this is something that's really, really easy to use. If you've liked the video and you found it useful, hit the like button, hit the subscribe button. We do weekly videos here of coming, and we also have a Discord community of traders where we post trading setups, trading resources, indicators. We do trading reviews, coaching, mentoring, all of the good stuff. So I hope you've liked the video, and I'll see you next week.